Are you wondering whether it's still a good time to buy, sell, or think there's a looming market crash? Let me clear that anxiety and give you some straight talk about the market update and what to expect. There are many things affecting the market, and though it may sound like doom and gloom, it's not, so stay with me here. Interest rates increased 69% to just over 5.25% for a 30-year fixed in 2022, but are still low compared to the last 30-year average. Inflation is at a 40-year high and expected to climb. S&P went down 14%, NASDAQ went down 22%. Listing supply is diminishing at a high rate. Homeowners are sitting on over $10 trillion of equity nationwide, and so many more unpredictable wars and post-pandemic anxiety. So now that we've covered the factors, let's see how they affect the real estate market. According to CoreLogic, home prices nationwide increased 21% in March 2022 compared to 2021. However, home prices nationwide increased 3.3% in March 2022 compared with February 2022. Now, in California, home prices increased 10% as California growth and demand has always remained higher than the average national stats. What I want you to hear with these stats is the rate of equity increase is dropping fast, but that doesn't mean there's a loss in sight. So that 20% plus appreciation increase that we saw during the pandemic, that's not gonna happen again. We are going to revert back to normal annual equity gains, which means the market is cooling, not crashing. Interest rates are increasing in hopes of fighting inflation, but it's not negatively affecting the market yet. In fact, it's motivating buyers to act faster and investors to put more money to work now to take advantage of lower rates. The rates are still low compared to the past. The fact that real estate is a great hedge against inflation is also in driving investors to the marketplace, keeping the market strong and steady. Yes, many have lost money in recent days on the stock market, but for many, the loss is not signified unless they sold during the time, which most haven't. They're just temporary losses. And speaking of the stock market volatility, that drives investors away from the stock game and into the long-term reliability of the real estate marketplace. Again, keeping the market busy. Listing inventory is overall declining, meaning it's still going to be a strong seller's market. However, San Francisco just saw a tad more listings than the month before. It's still only a 9-week supply, which is extremely low. And San Mateo County has only a 4-week listing inventory, which is insanely low. Less people want to trade their low interest rates to a higher one, so they're not selling and buying. Also, while rates were historically low, so many people upgraded their housing to take advantage of their increased purchasing power, but now that doesn't make sense. Low inventory means supply is low and demand is higher, keeping the market still strong. Look, even the hottest markets cool, but cooling doesn't necessarily imply a crash. In this case, I can tell you the housing market isn't going to crash, so you shouldn't wait for those severely distressed situations anytime soon. It's simply going to level off the appreciation to normalized rates, and home prices, though they will be higher than their previous year, may come down a little this year to reflect the correction. If you're a stats lover, I've posted a stat-heavy market report for both San Francisco and San Mateo County. Click the link on my bio or go to my website. Now, don't forget about that $10 trillion sitting in equity nationwide. Many savvy homeowners and investors are putting that money to work by refinancing and buying more real estate, which adds demand to the market. Next week, we're going to focus on that sitting equity and how to put it to work to make more money for you. I'll see you next week.